Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have the EIA show will be tomorrow due to Martin Luther King holiday, so that gets kicked over. So we're just going to have our econ show first. And in the first part, we're going to do a quick roundup. We're going to talk about Russia, provide an update on what are some of the new developments that have happened there. Then we're going to look at what's happened with food, some of the grains, some of the fertilizers in terms of pricing, and then looking at has global rates continue to surge when we're looking at the bond market, because I think that's important in terms of where is some of the stress going to come from over the really the first quarter when we're looking at how yields are really going to impact the equity markets and what central banks are going to do. And then when we're looking at some of the leading indicators in the US, we want to talk about the breadth of inflation and then really what it means. Like, where are we going to see some softness? Where are we going to see it hold? And then how is that going to shift now? And also, again, factoring in what's happening with the 10-year yield, because the 10-year is really going to be pivotal for what's going to happen in emerging markets. Then we're going to look at retail sales, rising costs, what happened with the U.S. empire, because that's really the first Fed region to start putting out some data. So we want to look at what does that look like and what is happening to wages on the back of it. Then when we turn to Europe, we want to look at how energy prices are really kind of driving inflation. And there's a view that as the inflation on the energy side drops, you're going to get a sizable move lower on European inflation. And we want to look at some of the reasons why that may or may not be the case. I'm obviously leaning to the fact that that won't be the case, but not to say that it won't come down a bit, but we'll go through that a bit more. Then we really want to go into China's GDP numbers, because on the surface, it was a beat. We all know how some of the official data can be, but we want to look at what's beneath the numbers. Like, because if you saw there was a GDP beat, but there was a huge sell-off even with that, and we want to look at why was there a sell-off, what are the indications we have going forward, and how the pressure, especially on the housing market and really the real estate market, is far from over. So now when we turn to what's happening in Russia, Ukraine. So we've seen the Russian stock market obviously collapse. Collapse is, I guess, a strong term, but really come down. We saw the credit default swaps really start to open, and it's really, I should say, move wider. And it's really because of the fear on what happens next. Like, Russia's continued to move assets into the region, and it's really into Belarus. So one of the things is the one thing that is coming up is the military exercise Allied Resolve, which is going to happen in Belarus and near Russia's border with Ukraine. So this is something that's going to happen out in two phases. So you have the initial combat readiness stage, which is scheduled to end on February 9th, and then the drills themselves from February 10th to 20th. So there's some fear that when you look at what happened right after the Winter Olympics, then you had that move directly into Crimea. So there's some concern that this is going to be kind of a prelude to, okay, well, everyone's there, it's ready, and now that you cross the border immediately. So that's in order to go against that and to try to essentially bump up against it, the UK has sent what effectively has become a trip force. They're soldiers that are training, but realistically, it's a trip force. And a trip force is a group where it's typically 100 to maybe 1,000 soldiers that are there to help deter. Because if a British soldier gets wounded or killed, or a U.S. soldier, then that will create a much bigger response. Where, not to say that killing a Ukraine soldier is a small matter, but it's something that brings it home. It makes it real for the home country. That's the allied country, and then could spark a much larger response. So we've had some decent amount of new equipment being sent in from the UK, from the US. We have Finland and Sweden, and I think Norway at this point, that have increased in military readiness. This just looks at how many assets the Ukraine has versus Russia. But obviously Russia has a lot more, but you have to think about the size of Russia and the size of Ukraine and where a lot of these assets are really centered. So the Ukraine is in a different position now versus where it was when this conflict initially started. There's more resolve. There's a way more organization. So it's not going to be the same type of movement. Now, what could really happen? So if Russia decides to undertake major military action against Ukraine, it would likely occur around the same time as the drills in response to an escalation of the Donbas conflict as pretext. So they could use this as like a means to come in, and that's just coming from Stratfor, who I think has done a good job of really looking at what is happening. So you also have to have the right ground, the right type of seasonality, if you will, just given that things are frozen. You can move heavy equipment. We've seen a lot of equipment being moved on trains. You have the Russian embassy in Kyiv being brought down. Non-essential people are being moved out. That could be a prelude to something else. And then Russian troops and equipment have already begun arriving in Belarus for the readiness drills, marking the first time that units of Russia's Eastern Military District have ever been present in Belarus. So that is why there's such a focus on this, because it's like, all right, well, this is the big increase, but we have to go back in time. And as we did that deep dive on Russia, Ukraine, we talked about the Budapest memorandum and what it meant. But we also have to think about Bosnia. So if you remember, the U.S. is bombing Bosnia and trying to help the people there. And then you had what happened in Kosovo. But when you look at what the U.S. was doing, and there was essentially a talk of U.S. Putting boots on the ground. Now, it wasn't really public until afterwards when there was some declassified information coming out. But Russia moved in essentially a tank column. And that was them reemerging to the world stage, because it was after the USSR had fallen, I should say broken up, and now they're coming back. So that was them saying, look, we're not what we were, but this is our territory. This is going to be our buffer. And then there was that back and forth between is NATO going to stop? Where are some of the negotiations going to be? Because we continue to expand who was in NATO throughout the Bush administration. And that created some strife in terms of where Russia was and where the U.S. was. Now there's negotiations on who will go in next, which is where we saw, when we're looking at Russia, talking about, again, Bosnia, Kosovo, and Georgia, when you're looking at where their actions are. And now, obviously, Belarus, which is a very important piece of the pie. But one of the things that I thought was interesting is looking at some baseline scenarios. So Russia demands for security guarantees and disputes over the Minsk agreements, which will keep the tension there. Now, we have Blinken right now in Ukraine. You have the U.S. showing some solidarity. We haven't really put a lot of assets to work there, but it's just showing that there's a certain amount of resolve. Now, what is Russia trying to get out of this? And I think it's really to stop the movement east of NATO, try to secure really where some of the offtake is. When we're looking at the gas sales, China's already been increasing their gas sales. They want to increase their gas sales into Europe, push through Nord Stream. So there's a lot of conflict in terms of economic national interests. So Moscow will also keep troops and equipment at the border, but a Russian invasion will not materialize. This is, again, coming from the Stratfor article. Seeing a credible military threat against Ukraine as leverage against the United States and a critical lever to slow its declining influence over Ukraine. Russia will maintain its buildup of forces, infrastructure, and equipment near the border to pressure the West to make concessions. While the U.S. and European leaders will hold talks with Russia, NATO will not formally disavow the prospect of Ukraine's membership in the alliance, but essentially make it very difficult for them to come in to try to placate both sides. Now, discussions on limiting... I moved it by accident, I apologize. Discussions on limiting the eastern deployment of certain NATO weapons systems and incident avoidance and management measures with the alliance will dissuade Russia from conducting a military insurgency in 2022. So this was written in December. So obviously there's been some adjustments in some of the things that are moved. You've had Kazakhstan happen. You've had some of the equipment that is still moving into the Ukraine border. But this is going to be an important backdrop because there's still pressure there. There's still an unknown. Now that is the rosier side of the situation. On the flip side of it, Russia felt slighted when Ukraine left the USSR. There was a lot of hope within Russia and then actually within the US that the Ukraine would stay within the Russian influence. And that was when President Bush Sr. at the time gave the whole speech about independence versus freedom versus independence. You can have your freedom without your independence. And there was some of that push to keep Ukraine there. And Russia was trying to create a union, not obviously the USSR type, but more of a treaty construct with some of the other members, and Ukraine was a huge piece of that. And without Ukraine and their military capacity and their manufacturing, Russia wouldn't be able to maintain that. So when the Ukraine did announce their independence, that fell apart, and that's where Russia felt as though that was the wrong move. They felt slighted. Everything went through. Russia went into a deep recession. There was a huge issue in terms of, I think it was, they lost 96% of their GDP, their economic value. So this is something where Putin does not forget easily, as we've seen, and this could be that start to again moving to a new level on the global stage. But these are some of the back and forth. Now, I think this is a lot of pressure that's being put on. Belarus is a big escalation point, but at the same time, the West is also escalated by moving more advanced equipment, moving more people in. So it's going to come to a point where I think it's going to come to a head. There will likely be some sort of border clash, and then the de-escalation will escalate from that point. Now, if I'm wrong and there is not that de-escalation at that point, then we will see a very quick move into Ukraine, and it will happen. We should really know what the intentions will be by the middle of February, but you have to plan accordingly. You know, you always want to assume that things can be worked out diplomatically without the loss of life, but at the same time, you have to be prepared to make that call, which is, I think, where we sit right now in terms of some of the additional assets. Both equipment and manpower are continuing to move in. Now, Germany has said they want to stay out of it. We've had different aircraft avoiding the German airspace. So there's a lot of back and forth on that in terms of where we sit, especially on the NATO front. So this is just something to consider when we're looking at the different sides and where this is going to play out. But again, we'll keep providing updates as they come available. Now looking at, and what is happening on the global debt side, because as we've been talking about, post-COVID, when you look at where global debt, now we have the official numbers for 2022, where things were into 2021. Things are always a little slow when you get the official, but we know where we are into now. Some of the debt has started to come down. You've started to see some of that pare back. That's also being helped from the increase in rates on the central bank side. But we knew this, this is just where are we right now and where are we going to be? So this is just showing the global debt experienced the largest surge in 50 years. And I think it's important to put that into context. And I think this is a great chart from Deutsche Bank, looking at where we were in relation to the 1940s in terms of the early 1920s, and you get an idea of kind of where we sit, where we're still rising, starting to crest a bit, and you can see just the level and the amount in which we have debt. And this is just thinking about this is debt to GDP ratios. Because the nominal number, the actual number is obviously a lot larger, but GDPs are a lot larger. So you have to try to weigh kind of where things are and what that's going to look like. So when we look at Japan, obviously what Japan has been elevated, Italy as well, and then the US is cresting on that upper end, which is where we think things start to peak out, but the question is, how much do they peak? Is there a panic if we start to get a slowdown, if we start to get a retracement in equities? Because central banks have wanted to maintain a lot of that momentum. And this is going to be something very important to watch as we progress through the remainder of the year. So then when you look at the global bond index, here you can see the bond index has come down, and this is price, again, when you think of price versus yield. So we've started to see yield really starting to shift up, and that is going to be something else when we're considering what that pricing is going to be and where this is going to reside at, as people are looking for a bit more safety, and you're getting some of this move out of global bonds. We have seen a big increase on foreign purchases of U.S. treasuries, which should help insulate a bit as the Fed continues to accelerate their pullback of buying, or at least what they're saying going to be the pullback. Now, when we look at the diffusion index, and it's a percentage of countries with rising leading indicators versus ISM manufacturing, and things continue to show what we've been talking about on this negative move down, but there's a lot of pieces within that, especially when you look at manufacturing. Supply chains, pricing. So, but we do expect to see some of this pressure, and we've started to see that on estimates coming out of Q4 and what they're going to be in Q1. So the OECD data update for December, the percent of OECD countries with rising leading indicators month over month is down to 41%, which is the lowest monthly print since April 2020. This also suggests the ISM should drop below 50 by late Q2, early Q3, which is leading into some of and raise the bar, or on Twitter has been talking about this deflationary concept that could really start to hit. Now, I think that we get a stagflation, one last inflationary push, and then you get that deflationary move, which moves me more into the Q3 camp. But given things are very fluid, things can adjust. But that's where we're going to want to look. And when we're looking at that, we want to understand, well, where are bond yields? Now, this chart is from, as you can see, January 14th. It's already been aged out because Germany is now positive. So the 10-year government bond yields are now positive for Germany. So all of these levels you can see are now on the positive front. And again, this is looking at nominal yields. Real yields are still negative, but you're getting an idea of kind of what that pressure looks like between that real and nominal. And it's only going to continue to get worse when you look at what the central banks are doing. And one of the key important ones remains the Fed. So when you look at the Fed, there's now the estimate that we're going to get 3 rate hikes. And when you look at some of the estimates, like Bloomberg has them, a bunch of different entities will publish them. There is now over 100% chance of a raise in the next March meeting. And you might think, well, how can it be over 100%? And the reason is because there's a view now, or there's a growing view, that it's not going to be a 25 basis point increase, but a 50 basis point increase. I don't think they do that. I would like to see them do it personally, but I don't think they will. I think that would be a little bit too much of a shock. I think that we'll get 3 back-to-back increases with a likely 4th after they let the market absorb that piece. But that, and instead of doing the 50 basis points, that's why I think they do the 25, the 325 back to back to get some of that, to take some of that wind out of the sails of the inflationary push, if you will, and before we start to see that slowdown in activity. Now, when we look at where things are on the bond yield side, this is where it gets interesting, because if you were to look at where the leading indicators are and where the 10-year bond yield is, you would assume that the 10-year bond comes down. But there's some conflicting pieces to it. And this is just looking at one specific leading indicator, and this is talking about growth. So typically when you have growth slowing, you should have yields falling. But right now, and because growth is slowing, people sell equities, they go into bonds, which then increases price, lowering yield. But it's more complicated than that. And not to make it too complicated for those that are listening, but when you look at bond yields versus inflation. So when you look at inflation has surged, but the 10-year treasury yield has been relatively subdued. And if you look at historics, this is just, look at the gap between where the bond yield is now versus where core U.S. inflation is. So yes, it may not go up as much because growth is slowing, but it has barely even recognized the inflation, which is why I do think 2% is very likely. I've said that since the beginning of last year. I actually wrote a paper on it in February that we were going to get there, and then I have some friendly bets out there. on when that will happen, and the view is that will happen as we go into. I think it's going to happen in Q1, but the cutoff date was by the midterm election. So always fun back and forth. Now, when we look at some of the households, so debt to disposable income for selected countries, just looking at where that spending is, the U.S. is still just below 100, but some of the pressures increasing in other areas, and it's Canada, Australia, UK, and these are key areas. These are OECD countries. They're in the developed world, and yet you're starting to see how they're living on the edge and where the pressure sits when we're thinking about consumption as we get that fiscal and monetary cliff, which you get that slowdown, and where those pressures are going to rise, and why we continue to talk about a sluggish global consumer, not just the U.S. Obviously, the U.S. is the largest, but a global consumption slowdown. But when you look at how things are changing, how things are shifting, I think this is interesting because it talks about the experience from using telework during the COVID-19 crisis. Now, obviously, workers and managers are going to have different views. You could see that very positive workers were higher than managers, but you're seeing that somewhat positive, very positive is still the lion's share of experiences, which is, again, why we expect to see some structural shifts when we're looking at work from home, flexible schedules, and how that's going to continue to sway. And really, what is that going to do to demand? Crude demand, gasoline demand, diesel demand, as people look to drive a little bit less during the weekdays, maybe a little bit more on the weekends. But it also can adjust how people consume, in what way versus online versus in store, going out for drinks after work. If you're not in the office, what is that going to do for some basic consumption that I think we've gotten used to seeing? And again, I can make predictions. I have so far. So far, we've been more right than wrong when we're looking at how demand was going to adjust. But I think this is going to be more of that prolonged view in terms of where do people live? How do they live? Are they home more? What does that do for online shopping? And I think that's going to be a fun thing to really try to look at. Now, energy prices rising is also draining liquidity from the global system. And I think this is an interesting point because when you look at the monetary and fiscal transfers that we have, fiscal being government. So when you look at the government transfers from obviously the government side into the consumer, that increased savings, that increased a lot of consumption. But now with energy prices where they are, that is accelerating the move out of savings because you have to buy gasoline, you have to buy diesel, you have to cover the rising cost of diesel on goods. You have a lot of these things increasing, which is just sucking that liquidity that we saw get moved into the market to move to the consumer, which is why I connect that back to the global consumer and the pressure that's going to remain. Then when you look at commodity in short supply, so a significant rollover in reports of commodities being in short supply per December. Now it got better. It's starting to get a bit worse, but this is more a global commodity comment because when you look at housing starts versus housing completions, housing starts are way up, but completions are down. Because people are struggling to get copper, copper piping, copper wiring, PVC piping, PVC, roofing, lumber. So now we're starting to get some of that catch up. So we should start to see a little bit of an acceleration in some of those construction areas, and on the German side, we should see that on the car front. Now, shifting gears a touch to what is happening on the agriculture front. This is looking at global food prices, which hit the highest since 2011. Remember, this is our base case scenario that we were going to take out the highs from 2011, and then we're just going to go sideways, and we're going to see a lot of that pressure that's going to remain. And that's where I think when you start looking at some of the uprisings, some of the pressures, some of the protests, this is where we're getting them from. And remember that 2011 was the Arab Spring and when we saw that big increase in activity. And it's the reason why we think it's going to continue to get worse through 2022 is the South America soy output forecasts are continue to get cut. Argentina cut it as I tweeted out, Brazil as well. And then here you have just with what the USDA has said, but the USDA is actually above the estimates that Brazil and Argentina put out, because remember, they came out first. And it just shows you how things continued to get taken down, where there was an assumption that we were going to be above the 21-22 December views. And now you can see that they're getting walked back due to the drought and due to the yield issue. There's also, on the other side, the fertilizer component. So fertilizer's gotten a little bit cheaper. It has gotten a bit more expensive again. This is going to fluctuate, but you can see that it's off the highs. But when you zoom out, you can see that it is still elevated. There is still a lot of pressure, and this is going to support elevated prices through really the end of the year, at least when we're looking at crops and agriculture in general. And then when you look at wheat, inspections for export near 2-month high, you're starting to get some bounce in some of these commodity prices after seeing some of that walk back. Now we're starting to see grain prices, futures increase again. And this is just looking at some of the soybean harvest in Mato Grosso. So far, it's seasonally normal. 4% of harvested as of Friday, slightly behind the average of 5%, but at least 2 weeks ahead of the year-ago pace. Recent rains have been slowing down the earliest harvesting, so you're starting to get a little bit of movement, but this is going to be, I think, a key one really to watch, mixed with the issues that continue on the supply chain front. So Antwerp, Europe's second largest container port, sees a rise in traffic in January. That is going to continue as we see some of these, the level of containers increasing. Container ships at Los Angeles and Long Beach port hit a record level again in January. And now that we have, this is going to keep imports coming through over the next few weeks. But then when you look at the issues in China with COVID continuing to spread, lockdowns, slowdowns, port issues, that's going to create residual problems, which is why we don't see the supply chain getting repaired by the end of the year. It will start to improve. And it'll start to, some of the costs will come down, but this is just showing you how much wood we have to chop, how problematic things still are, and how that's going to clearly impact Q1, Q2 before we start to see some of those adjustments in price. So that's what we have for you on kind of that global roundup. And now in the next segment, we're going to go deeper into the U.S. data, leading indicators, and where we see things going from here.